Oh boy, 6 hours of driving today. Yeah, it's really taking a toll on the mental. About 4 hours of which my son was screaming his head off, and he was screaming all last night. Not to complain too much, but to say I did not plan on making this video. But you guys know me, I like to take in a lot of different opinions, a lot of different takes on especially different events, like when we're heading into a CPI report, when we're heading into earnings season, heading into a Fed meeting or retail sales or anything like that. I think it's especially important to, one, challenge your bias, okay? To challenge your thought process, okay? And I've, for the last 2 weeks or so, been leaning more towards a sell the news event. Now, I have to be honest with you to start off this video. I am drinking this soft parade shandy. It's like a strawberry lemonade shandy. And I really can't make this up. It says Shorts Brewing all around the top of this thing. So I don't know if that's like, I didn't know it said that until actually just now I read it. It's literally got shorts on the can. I swear to God, I'm not making this up. But yeah, so we are having a drink here in this video, just like you should do, you know, if that's your thing, right? Before a holiday-like event. This, for anyone in markets, the first Fed cut is like Christmas again when you're 10 years old. But kind of without going into this too much, without rambling too much, I came across this video on CNBC. And wow, like I had to share it with you. I did not have a choice. This individual talks about the 50 basis point cut and how that's probably not going to be good for markets, which is something a lot of Wall Street does not want to talk about right now, especially since we've had 7 straight green days heading into tomorrow. People want to sell to their clients. People don't want to panic their clients, right? They want people's deposits to stay invested with them. And honestly, I don't think we've ever seen an easier sell the news event around the first Fed cut. 7 green days in a row. Tomorrow would make 8. This 2-week period in September is by far the worst 2 weeks for markets throughout any year by a long shot. October's not much better. You have an election coming up that's not priced into markets. Markets are absolutely expecting a soft landing. There is no recession priced in the S&P 500 whatsoever. At the same time, almost every single economist, 96% of qualified economists, around 120 of them or so, are expecting a 25 basis point cut. The markets are pricing in a 50 basis point cut with about a 66% probability or so. So unless something dramatically changes overnight, you're going to get a 50 basis point cut, and 96% of economists are going to be wrong. I don't know how you could paint that as a, positive event short term for markets. Now, 50 basis points is obviously going to be better come November, December. As long as the economy's not in a recession, then we're going to have more loosening from the Fed under our belts. Hopefully we get another cut or two. That's going to be good. But what this guy also talks about is something I have said many times here on this channel. That's literally, this is what he says. It seems like somebody is getting the data before the markets. Huh? Well, he referenced, let me just kind of break this down a little bit more. He referenced the sell-off that we seen that was pretty aggressive today. From the high of the day, you were up about 0.7%. You sold off negative almost 0.5% on the S&P. And he said we've seen this with CPI reports and specifically, specific company news events over the past couple of weeks and months where it seems like somebody gets the data first. Perhaps this sell-off, as this guy is suggesting, shown that somebody got that Fed report early. And what's in that Fed report may not be great. Now, why you don't see the whole market's dump, let's say, theoretically, this report is really bad. It was leaked to, some big firms, some market makers. you would expect markets to tank right tomorrow, and maybe that happens. But if it's leaked to them early, they're going to position for that. They're going to hedge for that, which can cause some aggressive downside price action, but you're not getting the rest of the markets that are also trading on that news. So it's that weird activity that you really want to pay attention to. And this individual basically said that maybe somebody got the Fed report. So take a listen to this clip. Hopefully you find it as insightful as I did. And you'll understand why I just had to share it with you towards the end. It's about 5 minutes long. I highly recommend you guys listen to the whole thing. And then we'll be back to talk about a little bit more of this and what I plan to do specifically heading into that Fed meeting.
Next guest says the market has backed the Fed into a corner and ultimately won't like the outcome. For more on how he's positioning, let's bring in Michael Landsberg. He's CIO at Landsberg Bennett Private Wealth Management. Which corner, Michael? Welcome.
Good afternoon. I actually agree a lot with what Rick said. I think we're positioning it for what we think is going to happen, not what I'd like to have happen. And I think we're going to see 25 basis points, but I think the market has gotten into this 50. We're going to have 50, and I think they're going to be disappointed. 50 really doesn't give us a lot of room here, because what will happen is people are going to say, what has the Fed been not telling us the whole time? 50 is typically an emergency cut. And I'm not sure why we would get that now, given the data that we're seeing out there, stock market at all-time highs. I just don't see it.
I am scratching my head a little bit, because first we had the retail sales report, which was better than feared. Then we had the market increasing the chance of a 50 basis point cut. I say, okay, maybe they're just reading the tea leaves of what they think is going on in the press. Fine. I don't really get it. Then I see stocks selling off as those 50 odds go higher. And now I really don't understand. Maybe you can explain.
Yeah, unfortunately, I think there's a little bit of a scenario. It seems like when CPI was going to come out, the market rallied. Somebody must have got the news ahead of time. I fear this is the same thing. It seems like when there's a big macro event, somebody gets the information a little bit earlier and the markets start to move. So I'm not sure why that's the case, but it seems that the last couple prints we've got, it seems like some other folks have gotten it a little early, and markets have made huge moves kind of, in before the actual data comes out. I hate to say that, but that's at least what it looks like the last couple times.
Listen, I wasn't watching the tick by tick. I'll take your word for it. Obviously, if that's true, I'm sure we're going to hear more about it at some point. I just meant after the fact. I meant at 9, we've seen stocks turn lower throughout the morning as we've had a chance to digest the fact that consumer spending is still on track, and we might get a half-point cut, and somehow they're upset with this outcome.
Well, I think it gets back to, if it's really a 50 basis point cut and it's normally an emergency type move, what is the Fed not telling us? Is labor worse than expected? I mean, are there some things out there that they're seeing that we're not knowing about? And that's, I think, what the concern ultimately is. If 25 is more orderly, that's something that we can get our heads around. At 50, what does that mean? Is there something that's kind of out there that we don't know about, a little bit of the tip of the iceberg, and we're going to run into something 3-6 months down the road that the Fed sees that the rest of the market isn't seeing? I think that's the concern.
Yeah, if they do 50, I'm saying the beige book becomes a top tier indicator once again, because that's the one that seems out of step with the others and kind of telling us that things are not so rosy. Listen, I don't know if you have small caps in your portfolio. I mean, Arthur, Gallagher, Bellring, Constellation, these seem to me like larger cap stocks. But we have to talk about the Russell's outperformance. It's happening today. It's been happening on a 1-month basis. On a 3-year basis, the Russell 2000 is now up almost 10%, while the NASDAQ is negative. So even as I'm making hay of the stock market's weakness this morning, actually, that's not true of every part of the stock market. Small caps seem like they're suddenly the place to be.
Well, and small caps haven't been a place to be for like 3.5 years. So we have a little bit of a small cap exposure. I think the issue is when you look at the index has so many companies that aren't profitable. It's really a place to be a stock picker. Own a portfolio that owns some names. I would consider Bellring Brands to be a small cap name. It's a $7 billion market cap. It's in that small mid space. Yeah. And they've got a good story. Obviously, they're a play on the GLP. But I think you've got to look at where we've been. Small caps have underperformed for such a long period of time. Making their highs back in November of 2021. We're finally starting to see some life here, but I'm more of a fan. I'd like to see them have some outperformance more before I'd go broadly in a small cap. But I think you want to be defensive in this market. And obviously, if rates continue lower, that should be good for small caps. But I think in the large cap space, you want to be a little bit more defensive. Defensive has worked for the last 2 months. We think it's going to work in a lowering rate environment.
So again, the first reason why I wanted to share that with you is, some of the leaked videos that I've made in recent weeks comes down to the same thing that individual said, right? Somebody is getting the data before everyone else, and it's most likely if we were to just speculate, big money investors like BlackRock, Vanguard, State Street, market makers like Citadel, right? Virtu, these guys that need to be hedged for big macro surprise events potentially. And that's where really reading the tape is what it's called. Basically reading the money and where it's moving before big events can tell you a lot. Now, I actually didn't suspect much of like a leaked Fed report today during the day today. Now, yes, my son was screaming and crying for like 4 hours straight in the car ride, so it was very hard to concentrate and do what I normally do. But when that individual said that, it kind of makes a lot of sense. I mean, look at the S&P and what happened today. After you hit that all-time high, you did not close at that all-time high. You fell pretty dramatically. Now, this was likely just the hedges going in from the big players, okay? This is not the 2-3% down move that we could see tomorrow if we are, surprised by the Fed, let's say. But it's the initial hedging that these big players had to do. Now, that's obviously not confirmed. That is just to say if that individual is correct, we just listened to. That's what this was today, okay? That's why markets did not continue to go higher. You essentially got pump faked here on the day today. Now, markets did end up closing positive, so you are up 7 days in a row heading into this Fed meeting. And again, this has gotta be the easiest call I've seen in a long time of just this whole sell the news event that is coming. Now, what I found interesting about what he also said is he thinks we're going to get 25 basis points, along the lines of 96% of other economists. Not surprising. Markets are pricing in a roughly 66% chance of a 50 basis point cut. Those odds will move around heading into the Fed, but whatever is priced in over 50%, the Fed does. So right now, if we were to just say the Fed meeting is in 30 minutes, the Fed would be doing a 50 basis point cut, or else they're going to upset the bond market, essentially. And that's the last thing you really want to do, is upset the bond market, upset the stock market when you're starting a cutting cycle and there's already fears of a recession. So from that standpoint, perhaps if the news was leaked, if the Fed report was leaked, like that individual said, and by the way, that's the first guy I've seen publicly state what I've been saying in the past, 10 YouTube videos or so, or over the past couple of weeks, that somebody is actually getting the data. That's kind of mind-blowing, because most people on Wall Street would not even admit that is happening or that is a possibility. But you could say 50 basis points if we get that. Then, like he said, what's the Fed saying 3 to 6 months down the line that we should be concerned about? That's also problematic. You could also say that only getting 25 basis points is saying that maybe the Fed's going to take it a little bit too slow. Maybe that's already long priced into markets, and maybe that's not enough to keep stocks going from here. Either way, I find it hard to look at the bull thesis, generally speaking, on the S&P 500 with all of these other things going on in the short term. Now, whether or not markets fall 20, 30% or rise 20 or 30%, that depends on whether or not we go into a recession or actually have a soft landing, in which who knows at this point what's going to happen. We won't know until we know. And by the time we know, you better hope you're hedged in cash or majorly in this market, because most of the returns in stocks come just within a couple of days. But nonetheless, I do think tomorrow is very important in setting the stage for the next leg of this bull market, which is going to be a broadening out of this bull market. It's going to be small caps outperforming, cyclicals, value, defensives, as that individual said in the CNBC clip we played in this video, and not just big tech. Big tech had its moment the last 18 months. Because that's where the earnings growth was. Interest rates being higher didn't really affect their growth. They actually benefited from taking in more cash, basically boosted their bottom line via interest on their cash. And now that is starting to go away, presumably with lower rates, there is a lower odds of a recession. These things are not really good for big tech, okay? So I think if you want to be in this market, if in the short term, if you're not looking on just trading or, buying the dip, I do think you want to be underweight big tech, overweight the rest of the markets. That's my personal opinion. That's not blanket advice. I'm not a financial advisor. You will lose your money, potentially all of your money, if you listen to somebody on YouTube. But that's personally what I am doing. Now, for specifically tomorrow, I do think some hedges make sense on your portfolio, even if we rally throughout the day tomorrow and even after the Fed. Odds are really good that we have a really bad Thursday. Okay, we've seen that before where sometimes the markets will just rally after the Fed. It's that blow off top positioning. People get super bullish really fast, and then it all comes crashing down by the end of the day, if not by the next day. We've seen that a lot in 2022. It wouldn't surprise me if something like that happened again. And if you wanted to trade this event, you can always just wait until the event and see what direction the markets are going to go in. But again, you probably don't want to trade this event more than you want to start positioning longer term around this event for areas and sectors that will benefit from Fed rate cuts. So with that said, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.